Hello again. We're now going to talk about the remaining credit derivatives. So these three credit derivatives here, we're going to spend a little bit more time on credit spread options and then just briefly mention how total return swaps and credit linked notes work. Okay, so let's start with credit spread options. Here. Okay, so credit spread options are options whose underlying is a spread. So a spread between what? A spread between a yield on a given risky bond and the yield on a risk-free bond. Okay, so the payoff of the option is defined like this. This is for a call option. The usual expression where you have the maximum between 0 and something being the value of the spread at the exercise date and the strike spread, if you will. So the value of the spread that is fixed and is defined as the strike of this option. And then this multiplies by the duration of the bond at the beginning of the option contract times the notional that we contract in the option. So why is the duration here? So the idea is the following. This duration is actually the modified Macaulay duration. We did not talk much about this Macaulay duration when we talked about fixed income, but you probably have seen this before in an investment type of course. So it's the same idea of duration, the difference being that the rate that we use to discount is the yield to maturity on the bond itself. Okay, so it's similar to the expression we used for duration in the fixed income course, but instead of using a zero coupon rate, we are using the yield on the bond directly. Okay, so we usually call this D0 the Macaulay duration, and then we divide this by 1 over the yield and call that the modified duration. Right? Why are we using the yield to maturity here? Just because, as you know, the yield to maturity is something that is easily observable. So if you know the market price of the bond, you can very easily compute the yield to maturity, and it's a number that everybody agrees on. Whereas an interest rate is something that has, a zero coupon rate is something that has to be estimated, like for example using the Nelson-Siegel model, and the numbers depend on the method you use to estimate, whether you use the Nelson-Siegel or use Bootstrap or use Svensson or whatever. For yield to maturity, there's not that problem. There is just a unique number for this yield to maturity. So the idea is that the payoff of the option is designed in this way because it's going to compensate the investor for a loss in the bond value due to an increase in the bond credit spread. Okay, so that's the goal of defining it like this. Please read through these details here to see the math of how this is exactly the symmetric of the change in the value of the bond. Okay. So the idea is that this derivative, this spread call option, will hedge an investor against a change in the bond price coming from an increase in spread, which may come from a rating downgrade, for example. Okay. So here's an example. So suppose you have a bond manager that believes that corporate credit spreads will widen in the next 6 months. So the prices of the bonds will drop, and therefore the spreads will increase. So he wants to hedge his portfolio with credit spread options. So let's say that the initial position is this $1 million of this particular bond, a 3-year B-rated corporate bond with a coupon of 9%. So let's assume that the yield to maturity right now is 9%, and therefore when the price when the yield is equal to the coupon, the price is 100%. Right? Let's say that the treasury bond yield is 5%, and therefore the corporate spread is the difference between that yield of 9% and this 5%. So the corporate spread is 4%. Okay, so the credit spread option will be an option on that spread. Okay. So the hedging strategy, we're going to buy a 6-month call option with a strike equal to that 4%, and with a notional equal to the market value of the bond, which is this $1 million that we have. Okay. Okay, so we can compute this duration of the bond at the beginning of the contract. Okay, I'm actually going to post these calculations in detail, but I think you can easily go through these numbers yourself. So compute the standard Macaulay duration for this bond, then divide by 1 plus the yield to get the modified duration, and that is what you need to use here for the option payoff. Okay. So let's we start this hedge, and now let's see what happens. Okay, so let's see what is the outcome. Let's assume some scenario. So let's assume that at the maturity of the option, 6 months from now, spreads have indeed increased. So the yield to maturity on the bond has jumped from the previous number, which was 9% to 11%, while the yield on the treasury bond remains at 5%. Okay, so the spread that was initially 4% has gone to 6%, right? So this is a bad case for this investor, right? Because this guy is holding bonds. If the yield has gone up, the price has gone down. So he's losing money on his portfolio. And if this works as it should, the derivative is going to compensate the investor. So the money that he's losing on the bond is going to be compensated by the money that he's going to make on the derivative, on the call option. Okay, so let's see what happens. All right, so first let's start by computing the price of the bond at that moment. So 6 months have passed, so we are now at times 0.5. The yield is now 11%, so we're going to discount the future cash flows at this new yield and compute the price. All right? Again, I'm going to give you the detailed calculations for this in a separate picture. Okay? So the value of the portfolio is now that price that we just computed times the face value that we started with, which was 1 million, right? So now let's compute what happens to the derivative. What is the payoff of the call? So the spread is now 6%. I am going to exercise the call because recall that this is the way it is defined. It's the maximum between the current spread, which is 6%, and the strike, which was 4%. So the option is in the money. I'm going to exercise it, and the payoff I get is the difference, 6 minus 4, so 2%, times the duration that we computed at time 0, times the notional that we contracted, right? So doing those calculations, we will get a positive amount of $50,626, right? So the total amount of money that I have at this moment is going to be the payoff from the call and the value of the portfolio. So if I add up the two numbers, this is my total value today, right? So how do I know if this worked or not, right? Is this really hedging or not? So notice that to understand whether this is working or not, I have to decompose the two things that are happening here. So there are two things happening at the same time. So first time is moving forward. Okay, we started at time 0, but now we're at time 0.5. So there is that effect in the value of the bond. And then there is a second effect, which is the change in spread that we discussed from 4 to 6%. Okay. Now, the option only protects against this second effect, against the change in the spread, right? So to see whether this is really hedging or not, I have to decompose these two effects and see if I am being hedged against the spread change, okay? So what I'm going to do is I'm going to compare the value that I get here to the value that I would have if time had moved forward, like needs to, but interest rates and therefore spreads had not changed. What does that mean? I'm going to compute the value that I would have at time 0.5 if the spread had remained at 4%, or in other words, if the yield had remained at the initial 9%. Okay, so recompute the price of the bond at time 0.5 using a yield of 9%, find that value, and then find the value of the portfolio. Okay, and then you will see that these two numbers are very close, right? So the option is working reasonably well. Okay, it's still not perfect. There's still a slight difference for the reasons that we discuss here. All right, but I mean it's in the right range. It's reasonably close. Okay. Okay, so it's important to note this difference to credit default swap. So while credit default swap the name suggests that it only protects against default, a credit spread option protects against any change in the spread and therefore in the credit quality. All right. So I'm saying that the credit default swap only works against default, but that's not exactly true. Okay, and that is something that let me leave the question open here in the video. The credit default swap actually does not protect me only against default. It also protects me against these other events like a decrease in the credit quality, even though the name does not suggest that, even though the name the credit default swap seems to suggest that it's only protection against default. But in fact, in reality, it also protects me against other events prior to default, like a change in the credit quality. So think about that, and we can discuss in class why that is the case. All right. All right. So let's move on to the next credit derivative, which are total return swaps. Okay. So this, as the name suggests, is different in the sense that we are now swapping, exchanging the total return on a given asset. So this figure here illustrates the credit derivative. So we have two counterparties and an underlying asset, the same setup as in a credit default swap, but now the difference is that one side sends to the other, so the protection buyer sends to the protection seller the coupon that comes from the underlying asset plus any price increase or price appreciation in the underlying asset, right? In return, the total buyer receives a floating rate plus a spread. This spread will be the price of this total return swap plus any price depreciation that comes that this underlying asset suffers. Okay, so what we're saying is that any price increase goes to the other side, while if there is any price decrease, I get it from the other side. So basically, any price increase on the underlying asset is moved from the protection buyer to the protection seller. So this guy here, the protection buyer, becomes totally immune to any changes in the value of the underlying asset. Okay? Hence the name total return swap. So there are a bunch of cool applications of these swaps that are discussed here. Please read through this. We can discuss this in class if you have any questions. Again, this is a different type of derivative that allows for for these different strategies that are not achievable with credit default swaps. Right? Finally, the third type of credit derivative are credit-linked notes. Okay. So how does that work? So the idea is the following. This is a note in the sense that it is debt, like it's just like a bond, issued by, say, a bank like this. But the difference now is that this note is linked to a portfolio of assets which have credit risk. Hence the name credit-linked note. So the note that is issued is linked to these credits. All right? How is it linked? In the following way. So the bond is issued to some investors. At the beginning, the issuer gets the proceeds, and then periodically it pays some coupons. So far, this is just like a regular note or a bond. The linkage to credit comes through the payment at maturity. So the idea is the following. If at maturity nothing happened to the portfolio of assets, then this guy pays to the investors the full amount that was due. So in that case, this would work exactly like a regular note. But if at the settlement, if at maturity of the note, we look at the underlying assets and the underlying assets have suffered defaults, So the value that they have now is lower than what it should be. Then what we pay to the investors is also lower than it was promised. So you see that if I'm the issuer of the credit-linked notes and I am suffering losses in my underlying portfolio, then I am compensated in a sense because I don't pay back to the investors everything that was due. I only pay a smaller amount. So my losses here are compensated by paying less to the investors. Okay. So nothing is free, obviously. So this credit-linked note will have to compensate investors for taking the credit risk of these underlying assets, and they have to be compensated by receiving here a coupon, which has to be higher than the typical coupon of a bond issued by this same issuer, but without this linkage to credit, okay, to this credit risk here. So here's a quick example of this with some numbers, but has exactly this idea that I just described. Please read through this, how this works with some numbers here. So it's exactly the setup I just described. The coupon is 7.5%, presumably above the rate that this bank would pay on a standard note to compensate these investors for taking the credit risk of this credit card loans portfolio. And the credit risk transfer is specified, for example, like this. If there are defaults below 10% in this underlying portfolio here, we pay 100% to the investors. If the credit defaults are above some threshold, for example, 10%, so 10% of my of my loans are not paid back, then I only pay to outside investors a lower amount, like 85%. Okay, and that's it for credit derivatives. Thank you.